Welcome to this lesson from QLog Learn Median. I'm Julianne, and today we're looking at one of the most important payment security tools in international trade. If this kind of practical knowledge is useful for your studies or your career, subscribe to the channel. We publish lessons like this regularly. Today's topic, the letter of credit. It's a bank's own payment promise, used to protect exporters against the risk of not getting paid. We'll answer the three most important questions. Who is involved? How does the process actually work? And what makes it legally binding? As always, a concrete example will guide us through every step. A letter of credit is a bank's own payment promise. It exists to protect payment security, independent of the buyer's own solvency, and it clearly defines the exact documents required for payment, the bank's own irrevocable obligation, and the deadlines for shipment, presentation, and payment. Just as important is what a letter of credit does not cover. It says nothing about the underlying sales contract itself, nothing about the quality or condition of the goods, nothing about transport insurance, which is arranged separately, and nothing about resolving disputes between buyer and seller. All of that belongs to the sales contract. A letter of credit runs alongside the contract. It doesn't replace it. Four parties stand behind this one payment promise: the applicant, the buyer or importer who instructs their bank to open the credit; the issuing bank, it gives the abstract payment promise to the beneficiary; the advising bank, it informs the beneficiary and forwards the documents; and the beneficiary, the seller or exporter who gets paid once the documents comply. Remember this, banks pay against documents, not against containers. Is a letter of credit always the right choice? Let's look at the alternative. Documentary collection. With a letter of credit, the bank itself promises to pay. That offers maximum security for the exporter, but it's more complex and comes with bank fees. With documentary collection, the bank only acts as an intermediary. It releases the documents only against payment or acceptance, without its own payment promise. That's cheaper, but it offers less security for the exporter, and it's governed by a different set of rules, the URC 522. Let's look at the process in detail, starting with the sales contract. Buyer and seller agree in the underlying contract that payment will be made by letter of credit. The buyer then instructs their bank to open a credit in favor of the seller. The issuing bank first checks the buyer's creditworthiness and credit line before making the promise. An example: a machine manufacturer in Hamburg, Germany sells a production line to a buyer in Brazil. Since the two companies don't know each other yet, the exporter requires payment by letter of credit. The Brazilian buyer instructs their bank to open it. Next comes advising the credit, shipment, and the documents. The issuing bank sends the credit to the advising bank, which notifies the exporter. Only after receiving this notice does the exporter ship the goods, typically documented by a bill of lading, and assembles every document the credit requires. An example: the exporter's German bank advises the credit. Only then does the manufacturer ship the production line to Brazil and has the shipping line issue an onboard bill of lading, exactly as we discussed in our bill of lading lesson. Now to document examination and payment. The exporter submits the documents to the advising bank, which checks them for compliance. The documents then go to the issuing bank and the value is settled. After its own check, the issuing bank releases the documents to the buyer and debits their account. An example: the advising bank checks the bill of lading, the commercial invoice, and the certificate of origin exactly against the credit's wording. It credits the exporter and forwards the documents to the issuing bank in Brazil. Now to the legal nature, abstract and irrevocable. The letter of credit is legally independent from the underlying contract. The bank examines only documents, not the goods. Under Articles 2 and 7 of the UCP 600, a letter of credit is always irrevocable, even without an explicit agreement. There's no single national law that governs it. The basis, worldwide, is the UCP 600 of the International Chamber of Commerce, recognized in more than 175 countries. An example: the production line arrives with transport damage. The bank must still pay if the documents comply with the credit, because it deals only with the paper, not the actual condition of the goods. Let's move to the most important types. First, confirmed and unconfirmed credits under Articles 8 and 9 of the UCP. With an unconfirmed credit, only the issuing bank takes on a payment obligation. The advising bank merely notifies. With a confirmed credit, a confirming bank additionally adds its own equal-ranking payment promise. This extra protection against bank and country risk, however, costs a higher confirmation fee. An example: because the exporter is wary of political risk in Brazil, they have the credit confirmed by their German home bank. Even if the Brazilian bank defaults, they can still demand payment from the confirming German bank, provided the documents comply. Beyond confirmation, credits also differ by payment timing: side credits and deferred payment credits. With a side credit, payment is made immediately upon presentation of compliant documents. With a deferred payment credit, payment happens only after an agreed period, often 90 or 180 days, practically a trade credit for the buyer. Other forms, such as acceptance, negotiation, revolving, and transferable credits, cover more specialized trade situations. An example: if the Brazilian buyer needs time to resell the machinery before paying, the parties can agree on a deferred payment credit due 180 days after shipment. That gives the buyer breathing room while the exporter still holds a firm bank promise. Which documents does a letter of credit typically require? The commercial invoice states the goods, the price, and the terms exactly as specified in the credit. The transport document, typically a bill of lading, proves shipment and is often required on board. The certificate of origin confirms the country of manufacture, often needed for customs or preferential tariffs. Other documents, such as a packing list, an insurance certificate, or an inspection certificate, may be required depending on what the credit specifies. Remember this: every document must match the credit's wording exactly. Even small discrepancies can lead to refusal of payment. Let's compare letter of credit and documentary collection directly. On payment security, a letter of credit gives you the bank's own promise, which is high security. Documentary collection gives no bank promise at all, so security is lower. On cost, a letter of credit is more expensive because of bank fees. Documentary collection is cheaper. On legal basis, a letter of credit is governed by UCP 600. Documentary collection is governed by URC 522. And on suitability, a letter of credit fits new or unknown trading partners and high-value goods. Documentary collection fits established trading relationships where trust is already there. To close, the 4 most important points for your practice. First, read the credit terms precisely before shipping. Document discrepancies are the most common reason for payment delay or refusal. Second, for new or higher-risk trading partners, consider having the credit confirmed by a bank in your own country. That adds real protection against bank and country risk. Third, choose between sight and deferred payment based on actual financing needs, not just habit or what the other side happens to propose. Fourth, Remember, the bank pays against documents alone. Quality disputes about the goods themselves must be resolved separately, outside the credit. With that, we've reached the end of this lesson. Thank you for your attention and every success applying what you've learned about letters of credit. If this lesson was useful, we invite you to subscribe to the channel for more lessons like this one. A lesson by Q Log Learn Median.